Now, you're not seeing this wrong. We are just starting with the last two slides that we had from segment 2 for segment 3, because it's important to look at how red things are and the pressure that we're seeing across all metrics of inflation, some of them showing how sticky things are, and the biggest one being that trim mean CPI, which is now outpacing core, which is why we think there is a lot of staying power and that problematic move in terms of the Fed getting in front of inflation and trying to offset a lot of the damage that has already been done. And this just puts it into perspective that on a 1 month and 12-month ratio, depending on how you look at it, it's the Cleveland Fed trim mean is the largest on record going back to 1983. So again, we haven't seen, and every metrics was created in different times. So going back to 1983, where inflation was on the downswing, you had Volcker that was gunning rates, trying to get in front of inflation and the wage spiral. You're on the downward move, so it just shows where we are on that trajectory and the pressure that we continue to see, which is why it's not surprising to see that real average weekly earnings going negative again, because we continue to see real wages falling, even though they're going up on a nominal basis. As inflation's going up, they're getting softer. And then if you start thinking about, well, if the Fed is raising rates, that's going to push mortgage rates up, credit card rates up, equity lines, consumer loans, all of those things, car loans, everything is going to go up, which is going to make real benefit, the real wage and how far your paycheck goes much less. So then when you start thinking about the expected change in real income, so the expected income squeeze is here. The consumer, so this is asking the consumer, consumer's assessments of their personal financial situation worsened about 20%. 46% of consumers attributed their negative views to inflation, has only been exceeded once since 1981. So again, you're seeing more pressure where people are looking at this and saying, look, I know for a fact my income is not going to go as far as it has. And that's why you're starting to see that accelerating down move in terms of what people are willing to part with. So owner's equivalent rent, a key piece of that stickiness, May CPI inflation was up 5.1%, fastest since February of 1991 on the owner equivalent rent side. And if you think about where rent is right now, which is up 15.7%, houses are up 20.1%, there is still way more room for this to go, which is why we see more of that pressure. And when you start looking at the drivers of inflation, you can see that energy continues to be a big piece of it, and we don't see that stopping. We still see energy being a big driver of future inflation based on diesel, where diesel and gasoline, as crude has fallen, you're starting to see that flatten out a bit on gasoline and diesel prices. But there's a lot of stickiness, especially in diesel, when you look at middle distillate problems and some of these pieces that we've talked about in the EIA show. But one of the other key pieces that we've talked about is all items. So everything outside of food, energy, all of those things are going up in price. And that's going to continue to see that upward trend, creating that stickiness, which is why we do agree with something along the lines of what Bloomberg Economics has, where we're going to have some of that staying power through the year, and then it will start to drop off. You do have base effect, which means that the numerator is just a bigger number because you're starting from a higher point. So the rate of change will slow, but it's not that prices are coming down. It's just that prices aren't continuing to go up in the same rate. So that's where, but that stagflation is going to keep us elevated, and that's where we're going to continue to see this pressure. And they have expectations that it's still going to be well above what the Fed is guiding to, and we think that is very accurate and that the Fed is wrong on their expectations, which is where when you look at U.S. consumer sentiment for June is fallen to a record low, with consumers now feeling worse than during the great financial crisis, and expectations component has fallen to the lowest level since 1980. Again, showing why we think the retail spending continues to go negative into Q3, putting pressure on that growth. So when you look at the University of Michigan Consumer Sentiment, it's the lowest ever, plunges 8.2 points to 50.2 in June. Current conditions, record low. Expectations, lowest since 1980. And all components of the sentiment index fell. Again, just showing just how concerned the consumer really is, which is then when you start looking at it against vehicles, houses, large household goods, all of these are moving steeply down, which is why we do think that there is going to be the goods side, where services will continue to creep up, but goods, large goods, are going to continue to come down, and that's where we're going to get that meeting in the middle of both services and goods as as prices adjust. And that's when you start thinking about all of what we just said and why. Well, again, just to reiterate, weekly earnings continues to fall. And why does that matter so much? Well, we have to look at some of the leading indicators. So when the Philly Fed has gone negative for, as you can see, just how negative, and when it is now at a point that we are normally at during recessions. So the Philly Fed is typically a 6-month forecast when you think about where things are. And this is why the Philly Fed is usually a very important leading indicator. And again, you're seeing the pressure, which is why we talked about Q2 being that last piece of growth, and Q3, this confirming that we will have that negative. And now what was the Philly Fed? The Philly Fed index slipped into contraction territory in June for the first time since the summer of 2020. Now, some of the bigger issues is new orders dropped sharply to negative 12.4. Prices edged a bit lower. Inventories contracted. Delivery times fell. Employment moved up a bit higher, but the 6-month outlook contracted. So when you think about it, the 6-month outlook has gotten worse, and you're starting to see all of the leading indicators in terms of new orders, conditions continuing to, again, contract and become negative. So then when you think about, okay, well, we talked about Philly, what about the Empire? Well, June Empire manufacturing contracted negative 1.2%. Estimate was for negative 2.3. It was negative 11 in the prior month. Prices paid moved higher. So you're seeing, again, this meaningful move in pricing, showing that stagflation. Some moved up a bit, some moved down, but there's all holding firm at this elevated level. New orders expanded a bit while the outlook continued to worsen, again, showing some of that contraction continuing. Expected new orders coming down, unfilled orders dropping because they're filling that backlog and they're just not getting new orders. So they're exhausting what was already signed on, and they're not backfilling that supply chain, again, pulling things down, making things a bit worse. All the while, prices paid, as we've been saying, holding in at that line as expected delivery times get a bit shorter and better as the supply chain catches up a bit. So when you look at U.S. import prices fell for the first time since 2020. Some early indications of inflation coming down, but we're going to talk about in segment 5 how we're starting to see some of those prices come back up, especially in South Korea, which we're going to want to talk about. But there is a strong dollar appreciation. So as the dollar increases in appreciation, our spending ability goes up, which again helps us a bit to help offset some of those increases. But then when you think about future growth, inflation is still the most important problem for small businesses, but it's starting to flatline a bit as when you look at where small businesses are concerned, it's still inflation, it's still the quality of labor, but they're also getting very concerned. So when we look at sales expectation, firmly negative, uncertainty index, the highest it's been in terms of the, people are uncertain about the future. So if a business is uncertain about the future, they don't spend, they conserve. And then they look at sales expectations coming down, back to what we said on the Empire data, where they're not able to refill their backlog, which is creating some of those additional issues. So when you look at it, small business optimum index fell in May to 93.1 versus right in line with the estimate. The outlook component collapsed to an all-time low of negative 54%. expecting to ramp up hiring and raising prices increased while plans to increase compensation dipped. So this is where you're starting to see this conundrum, because inflation's sticky, you're raising prices still, but you're not increasing wages. So again, that's where you're going to start to see that additional pressure on what people can spend. The hiring plans ticked up a bit, but again, compensation. So you're having them move in the opposite directions. And they're going to try to take advantage as more people come back to the workforce and there's more competition for employees. They won't have to pay the same type of compensation. Price plans for the next 3 months are stable. Higher prices are being reported by a massive share of small businesses. As you can see here, 72%, but it's not yet having an impact on sales, given only 4% of respondents cited that as a main issue for them. So consumers are still taking in some of those higher prices, but we are seeing that start to slow. Now, some of the reasons why is because people will spend based on how wealthy they feel based on their homes. So the affordability dropped to its lowest level in 15 years on housing affordability. When the University of Michigan expected change in home values over the next 12 months, people expect their home values to diminish. If home values diminish, they start to feel more concerned about their financial condition, and that is another driver of them to spend less. A softening housing market was a major driver for the declines in May. So the net change in supply chain indexes for consumer inflation pressure, excluding housing and housing components. So again, you're seeing underlying response data for housing component price sensitivity, not purchased due to price, is increasing and staying elevated because prices are staying high. If you think about it, a home that was valued at $420,000 in March of this year versus a home that is priced the same as today, it's very different when you have a 3% mortgage versus a 6% mortgage, which is why we're seeing these pressure points in terms of purchasing. And then the net change from April to May in terms of category, non-discretionary goods, it's the price sensitivity in terms of what people are doing. People are consuming less, and a lot of that is being driven based on the price that they are seeing, which is keeping them on the sidelines. So then when you think about the home builder side, home builder sentiment fell in June to 67 versus the estimate of the prior, which was 69. 2-year low for headline index as market faces demand and supply challenges. Residential construction costs are up 19% year on year. Increase in rates has pushed many buyers out of the market, while also making it difficult for them to purchase given rates have gone up, which is why prospective buyer traffic has come down. Builder confidence update fell to 48, its lowest since June of 2020, as the housing prospective buyers has diminished. And why is that? Well, let's look. The update for this, as the mortgage rate has hit 6.13%. The mortgage rate going from 3% in January to over 6% today boxes out 18 million households from qualifying for a $400,000 mortgage. That's a 36% reduction in possible demand, taking people out of the market, reducing the available people to purchase a home. Which is why it's interesting that as all of this is happening, the retail net daily buying of energy stock baskets, and as we showed in the second segment, people are still buying equities, even though we continue to see these underlying pressures. And why is that as well? When you start looking at, but nominal wages are still going up, but it's not going up enough because inflation is so strong. And now as you have home values coming down, now you have small businesses saying that they're going to reduce compensation. That's going to push these nominal wages even lower. Which is why when you think about income expectations for the consumer, in terms of the University of Michigan sentiment update for June, are the lowest since the summer of 2020, as people expect to get paid less, which is why that nominal wages is going to come down, making real wages all that much worse. And then May housing starts were down 14.4% versus the estimate of negative 1.8%. Building permits were down 7% versus the estimate of being down 2.5%. Because people are now focusing on completing what they started their construction, because as demand slows, they're concerned they're not going to be able to sell what is currently being built. So why would I go out and build more in terms of new housing starts? As we've seen the mortgage rate again hit 6.13%. And one of those leading indicators, Epic, is luxury home sales. When you look at luxury home sales, sales have fallen 17.8% year on year during the 3 months ending April. Only 2 instances in the past decade with steeper declines being in, not surprising, 2020, as well as June of 2020 and then May of 2020. Now, Redfin had a bunch of commentary during their one of their interviews, and they see that May demand is 17% below expectations, and they don't have enough work for their agents, so they're going to reduce their workforce by 8%, and according to them, could be facing years, not months, of fewer home sales. So they see this being a prolonged issue, because realistically, if I have a 2.5% mortgage, why am I selling my home to go buy a new home that's still too high at a 6% mortgage? And again, you're going to see a lot of these pressure points coming through, which is why the fact that people are seeing their financial condition getting much worse. Consumers expect their financial situation to look much worse in a year. Expectations didn't take out February 22 trough, but are still worse than the low point during the great financial crisis. And we think that this is going to continue, while the consumer stress continues to ramp up, with average utility costs, gasoline, food, and home, electricity components of inflation surged by 25.7%, just slightly less than the peak in 1980, as we continue to see these pressure points. And again, this is real time. This is something that you see every day with what you pay gasoline and food and electricity. That's not going to adjust all that quickly. And again, this is going to keep that pressure right intact, which is when you look at food delivery price data points to further gains in food at home CPI, keeping people under pressure, which is why we see that stickiness in terms of what that inflation is going to look like. All the while, available inventory of homes for sale is up another 5.6% this week to 396,000. And it's because the slowdown has just left more inventory on there, which again is increasing the amount available. And then when you take a quick glimpse, it's the fewest price increases in 2 years. And again, you're still starting at a higher price, but you're seeing price, this is the fewest price increases. If anything, you're seeing a big decrease in prices, with current price cuts at 25.5%. which is now the highest since 2020, which is, you're seeing, again, some of that normalcy as people try to move their homes and trying to capture the last bastion of buyers prior to, I think, this really ending, even though I do think it has already ended. And this is just looking at all items and housing, again, pushing higher, keeping that pressure on the inflationary backdrop, and the monthly change in food and beverage moving up, four-month average continuing higher. Again, we see this trend moving up, as we talked about in segment 1, falling yields, lack of availability. That is going to keep the consumer under pressure, which is why when you look at weekly real earnings, the value is coming down, and that earnings is going to continue to keep people under pressure. I know I've said this, I've shown 3 different slides already. I just want to stress the importance of this, because it is shaking up so many things that we've seen. It's below where we were in 2008. Because we're going to see a lot of these different pressure points, with U.S. inflation showing a high breadth, which just means that the amount of components moving up, it's the highest since the 80s. And the breadth is so vast that even if you see gasoline come down a bit or something else, you still have so many components moving up in price that you're not going to see that impact, which is going to keep people on the sidelines, which is why inflation came in hotter in May at 8.6% versus estimates. And again, we see this a lot of staying power as core continues to move up. and the pressure remains on the consumer. And then the May grocery spend led by lower incomes in the South region, as spending growth by region continues to remain elevated as people are spending as much as they can to try to maintain their lifestyle. And then when you look at, are you shopping in stores? Here you can see that they're about the same, but somewhat or much less is increasing, because, and it's not because they're shopping more online, because they're not. It's because they're just buying less. So they're making less trips to the store because they are trying to protect their savings. Do you plan to eat at a restaurant in the next week? And you can see that the I do not plan to eat at one is increasing, with the I plan to dine in a restaurant is starting to come down. Again, it's just starting, so we do see some of this acceleration. Then, do you plan to travel in the next month? I do not plan to travel is starting to turn up. I plan to travel on an airplane is starting to turn lower. And we expect that to accelerate as prices go up, which is why, as we've been saying, we expect to see lower demand this summer than normal. Then, how concerned are you right now about inflation? 65% are very concerned, 26% are somewhat concerned. So again, most of the United States cares very much about inflation. How concerned are you right now about gas and energy prices? About right now, essentially 94% are very concerned or somewhat concerned about energy prices. And then, have you noticed packaging getting smaller? Again, this is shrinkflation. The answer is yes. So there's multiple sides to inflation, and shrinkflation is one where you're paying the same amount, but you're getting less. And as a family of 5, I can tell you firsthand that where one package used to feed all of us, now it's 1.5 packages. And that just means, but the prices didn't go down, so we're paying more and getting less, which again is creating even more pressure on the consumer, which we don't see ebbing, or we really do see actually accelerating. So that's what we have for you for the US. In the next segment, we're going to go deeper into Europe and what is happening on that front.